Hello and welcome everyone. Thank you so much for joining us on this Wednesday evening. Really excited to be here with all of you. Was able to speak with many of you yesterday and looking forward to sharing our most popular and informative webinar, a very comprehensive webinar going over the ins and outs of investing in real estate and also what we do here at Marshall Reddick Real Estate. So many of you, especially those of you new to us here at Marshall Reddick, may be wondering, what do we do here at Marshall Reddick? Well, Marshall Reddick Real Estate is a full-service brokerage. We offer three primary services. First and foremost is our brokerage. I myself am an advisor, and we have a staff of many advisors as well as property managers, private lenders, et cetera, here at Marshall Reddick. And we help our clients buy and sell real estate here in the state of California and also in 16 markets across the country. Not only do I help my clients with primary residences, but investment property, especially in our out-of-state markets. In addition to our brokerage, we are a private money lender. So for those of you who are looking for a more passive investment, you can lend your money. And for those of you who would like to finance your investment property and aren't able to utilize conventional financing, we have financing options available for you. Lastly, we're a property manager, so we manage our clients' investment properties here in the state of California and also in Texas, where we have our new office. We have a very special guest with us tonight, VP of Marketing and partner here at Marshall Reddick Real Estate, Scott Pastel.
Thanks, Daniel, and hi, everybody. Really happy to have you on here. Daniel and I have a lot of really good stuff to go over with you. As you can see on my screen, for those of you I haven't talked to or met yet, I am one of the partners of Marshall Reddick. Started with the company in 2005, so I've been with the Marshall Reddick now for 13 years, full-time. Own investment properties myself. One of my main focuses is also overseeing our property management. So if you talk to me, that probably means we're either meeting at an event or you'd like to know more about our property management. So I will be going over that in a little bit more detail this evening. But yeah, really happy to have you on here. And Daniel and I look forward to not only giving you a lot of good information for about the next 45 minutes to an hour, but also following up and talking to you more individually and helping you guys accomplish all of your real estate investing goals.
Thank you so much, Scott. And then a little bit about myself as a real estate advisor in Marshall Reddick Real Estate. Like I said, help my clients identify their investment criteria and create a plan to address short-term and long-term goals to ultimately achieve the returns and the real estate investments you might be looking for. I'm originally from Seattle. I moved many years ago, but I got my bachelor's degree in finance. I have experience working with beginning investors, people who have never completed a real estate transaction before, all the way through to advanced real estate investors with large portfolios into multifamily investments as well. And like I said, can help you in any one of our 16 markets. So we have a lot to cover today. First and foremost, we're going to talk about setting your investment criteria. What aspects of a real estate investment are important to you, the types of returns that you can use to evaluate an investment opportunity. We're going to talk about financing options. We addressed those a little bit already in terms of Marshall Reddick's private financing options, conventional options, and a few others as well. We're going to talk about doing proper due diligence, not only with the team you're working with, but on the market you choose to invest in as well, and the investment property that you choose to move forward with as well. All of those, there's aspects of due diligence that are important to evaluating your investment properties you are considering. We're going to talk about different calculations and formulas to evaluate an investment opportunity, whether that be calculations to analyze appreciation or cash flow. Different locations that we're in that provide the highest return on investment, the highest cash on cash return. And then Scott is going to cover property management ins and outs as well. This is a little art to show you what we do here at Marshall Reddick Real Estate. A quick snapshot. And you're going to notice that our presentation today is going to follow this format, the who, what, where, when, why, in terms of real estate investing. Starts with goal setting. Each and every one of you on this webinar tonight have a reason you're interested in real estate investing. Maybe you want passive income. Maybe you want to build wealth. We're going to talk about different types of investments that are going to help you achieve that goal. Then we're going to have to lay out a path. What are your options? Can you use conventional financing? Maybe you want to purchase cash. Do you want a duplex or a single family? We're going to talk about your time frame. Some of you are going to be ready to go next week. Some of you are going to be ready to go in a year. And some of you may be doing due diligence, saving, getting ready even longer. Like I said earlier, I work with investors from those starting out just now all the way to seasoned investors. So we're going to talk about time frame and then setting your criteria. Budget is involved. Property class, which we're going to talk a lot about later, is going to be involved. Each and every one of you has your own criteria, and that's important to understand completely to decide on the type of investment and market that's best for you, because each and every market has different nuances that make it a great investment for a certain type of investors. Some markets are better for cash flow, some for appreciation. And then who? The key players in a real estate investment and real estate transaction. That doesn't just include myself or our team in a market, but also your insurance agent, your lender, if you're doing a 1031 exchange, and your 1031 exchange intermediary. And here at Marshall Reddick, we have every individual on our team who's going to be necessary to complete a smooth real estate transaction so you have the best experience investing in real estate. Okay, where to begin as an investor? Well, we talked a little bit about it earlier. What goes into identifying your criteria? So purchase price. And that not only has to do with your initial down payment, especially if you're financing conventionally, but also what your qualifying or borrowing power is. How much money will a lender lend to you to invest or purchase a real estate asset? Property class. We're going to get into this in a lot more detail in just a moment, but different property classes are more suitable for different types of investments, whether that be appreciation or cash flow. And some investors prefer to invest specifically in A-class properties as opposed to C-class properties, and some investors only like C-class properties as opposed to higher property classes. Property type. There are certain benefits to single families over multifamilies and vice versa. Some investors prefer only to have multifamily properties in their portfolio, where some investors like single family specifically. Conditions, some investors would like to put a little money into their property, a little bit of value add, as opposed to turnkey options that are completely renovated. A lot of times there's a tenant in place ready to go. And then certainly more specific details, the age of the property, the size of the property, location, etc. So we talked a little bit about this earlier. Each and every investor has criteria specific to them that's important. Some of you are young. You're in your mid-20s, haven't completed a real estate transaction before, you're going to be working for a while, don't need that passive income yet, but you'd like to build wealth. Well, that's important to know because certain types of investments are going to suit your portfolio, your short and long-term goals better than others. Others of you are a few years from retirement. You have maybe a pension, maybe your 401k, but would really like to supplement that income that you are receiving now for your job that you're not going to have in a few years. And so you might be looking specifically for cash flow. That's why it's really important for us to know when you are going to retire. And then experience as well. I certainly wouldn't recommend anyone for their first investment to go buy a 10-unit apartment building. So it's important to know what your portfolio currently looks like, how you're structured, how many real estate investments you currently have, and the types of returns you're seeing from them as well. Risk tolerance as well, it's important. Some markets more volatile than others. Some markets we consider steady Eddie markets, very little volatility in terms of strong or rapid appreciation or depreciation, where others of you, are risk takers. And that helps guide us to specific markets that make more sense for your portfolio. Can you qualify for financing? Again, if you can utilize conventional financing, we certainly recommend it, and we have a phenomenal lender that we can get you connected with. If you cannot, would you like to leverage your property through private financing? Maybe you're an all-cash buyer. And then certainly that leads us to affordability. So below you can see our Reddick rating system. You'll notice that the Reddick rating system is going to be shown on every property on our website. If you haven't been to our website yet, highly recommend you all visit, look at the educational content, the properties. There's a lot of very powerful tools to analyze investment opportunities on our website. A little bit about the Reddick rating system. The further down you go on the scale, the lower the purchase price, generally the higher the cash flow. So a C-class property, that's where you're going to want to invest if you're primarily looking for passive income, because the rents are going to be higher relative to the purchase prices. The caveat is there'll be a little more maintenance and vacancy with those types, whereas an A-class property, the purchase price is going to be a lot higher. The rent relative to that purchase price won't be as high. Your property will be appreciating more. So if you're looking to build wealth, then, or more, in other words, if you're looking for appreciation more so than passive income, then you're going to want to target an A-class property. And we stay away from luxury class properties because they don't pencil out necessarily. The prices are too high and the rents are too low, and you'll probably be coming out of pocket every month to make up the difference on your mortgage. And those are neighborhoods where most of the occupants are homeowners. And generally speaking, if you can afford rent in a luxury class property in a metro, you can probably afford to buy. And D-class properties actually look phenomenal on paper, but they don't tell the whole story. Those are in poor neighborhoods with low quality tenants, the type of tenants that move out in the middle of the night, never to be heard from again. So the maintenance and vacancy on those types of properties eats away significantly at your returns and really end up being a large headache. All of this is explained in our property rating ebook. Those of you who I've spoken to or that I'm working with, I've probably sent you this to read and review and to ask me questions about, because this is a short read, but it's comprehensive, and there's so much information and education in this one book It really outlines our investment philosophy and explains how to choose real estate investments specific to your criteria and your goals. And it's actually available today as a handout. So you can download it right off the webinar. We'll show you where to find it on the website. I encourage each and every one of you on the webinar tonight to download and read this book. Again, it's very short, but it's comprehensive, and it's going to go hand in hand with evaluating investment opportunities on our website. And this is exactly where to find it on our website. At the top of our website, you'll see a little tab called Invest. If you click on Properties, it's going to be on the right-hand side, and you can download the PDF. A little more comprehensive breakdown of our Reddick class rating system, the type of tenants that you can expect from each property class. You know, your C-class property, where the purchase prices are a little lower, the rent's a little higher relative to those purchase prices, going to be more so of a blue-collar worker. Again, like I said, a little more maintenance for that type of property, a little more vacancy. You can expect a little more turnover, but those rents are going to more than cover your fixed and your variable expenses on that property, and you're going to be putting cash in your pocket, your cash flow every month. And as you move up the scale, you get a more professional quality tenant, a family with children. You know, I always say an A-class type of tenant is really a family that's going to take a lot of pride in your property. They're going to stay there long term. They're probably moving there because they want to be in the neighborhood. They want to send their children to the local schools, which are going to be higher rated. And then B class is going to be a little bit both. So if you're an investor, and they're out there who want appreciation and cash flow, best of both worlds, then B class is really the type of property that we're going to want to target. Okay, here you see a map from the National Association of Realtors. You can find this map on our website. Of course, we're not in all of these markets. We're very selective about the types of markets that we invest in. But you'll see that data on our website, especially regarding the median home price of a given metro, is pulled directly from the National Association of Realtors. So you can see step one, determine the current median home price of an MSA, is step one, because that's going to be directly relevant to the property class. So we've been talking about property class. Now, how is property class determined? Property class is going to be different for every metropolitan area. By that, I mean the price point for a property class is going to be different for every metropolitan area, because the median home price in Memphis is a lot lower than it's going to be in Austin. So you can see here a quick breakdown. C-class properties are properties that are listed for anywhere between 50% to 80% of the median home price for a metropolitan area. B-class, anywhere between 80% of the median and 100% of the median. And A-class properties, anywhere from 100% of the median home price to 130% of the median home price. And that's really the area we recommend investing in, that we stick in. Anywhere under 50% of the median home price is a D-class property. Again, those areas where you see a lot more maintenance, a lot more vacancy, they don't pencil out. And anything above 130% of the median home price for a single family residence is a luxury class property, where the income you're seeing from your rent is really not enough to cover all of your fixed and variable expenses on your home, and really are not in areas that make great rentals. Those numbers are adjusted a little bit for multifamily properties. You can see how those will change on the scale towards the bottom of your screen. Keep in mind those percentages are price per unit, again, of the median home price for that metropolitan area. All right, guys, that brings us to our first poll. We will launch shortly. One moment. First poll question for you guys. Which property class fits your goals best? There's a few different options we have available. Really excited to hear. We're not sharing, or your answers are completely anonymous. They won't be shared with anyone, but very curious to see what type of return is most important to each individual on the webinar tonight, whether that be appreciation, both appreciation and cash flow, simply cash flow, or maybe you're just here to learn and aren't sure yet which is best for you. All right, it looks like the majority of you are looking for both cash flow and appreciation. It looks like about a quarter of you are specifically targeting passive income, and then a small fraction of you simply want appreciation, don't necessarily care about the passive income or the cash flow. So very interesting results. This tells me that we have a very wide variety of investors and individuals on the webinar today. So very excited.
All right, thanks, Daniel. Well, I'm going to pop back in. It's Scott speaking now, and just as Daniel was going over the property classes, the reason that we went over the differences between A class, B class, and C class is not only to give you an idea of the location and demographic of tenants and the financial benefit, but also to give you tangible numbers on the difference, the actual tangible differences in maintenance and vacancy between different property classes. As Daniel mentioned, that we are a property manager, currently manage several hundred properties, and with our experience being in business for several decades across 16 different states in the US, or 16 different markets in the US, we analyzed tons of properties over about a 3-year period to identify a very, very common trend in the long-term maintenance rates and vacancy rates between different property classes. So the first table above is for residential real estate, which is classified as any structure with 1 to 4 units. The table below would be for commercial property, apartment buildings, 5 units and up. And I just want to give you a good understanding of this. These are not exact numbers, and these are not going to reflect on a monthly basis. This would be like if you own a property for a 10 or 15-year period, what the average long-term maintenance and vacancy rates look like. The percentages are based on the monthly rental amount. So to give you an idea, easy numbers, if you have a property that rents for $2,000 a month, if it falls into an A-class category, then you want to set aside $160 a month for maintenance and $160 a month for vacancy. Well, those of you that know investment property, you're not going to be paying vacancy. Vacancy is a loss of income, not an expense. And with maintenance, you can go months and months and months and months without any maintenance. And then if you have a tenant move out, you may have to put in new carpet, new paint, and maybe some handiwork. So let's say that could come out to a couple $1,000s. Well, yes, you may have gone a year or two without any maintenance, and then you have a couple $1,000s you have to spend all at once. So if you sort of amortize it out and average it out, these are what the average maintenance and vacancy rates look like between different property classes. The reason we see lower maintenance and vacancy rates with higher property classes is because we typically see a little bit more job stability and a little bit more of a long-term employment with A-class property. So that kind of helps with the vacancy rate. Less of a chance tenants are going to have to suddenly move due to a job loss, less of a chance they're going to be late in their rent payments. And then with maintenance, as Daniel mentioned, the quality of tenants kind of decreases as you go down in property class. Well, there's much less of a chance that these tenants have ever owned property in the past themselves or plan on owning property in the future. So with lower property class tenants, they don't really have the experience or really the interest in maintaining a property to the same standards that a tenant in a higher property class property would take care of that property. So we tend to see a little bit more maintenance in lower property classes, partly due to the fact that the tenants simply are just not used to replacing air filters or maintaining the life of a furnace or a dishwasher or on and on. So for various reasons, these are the numbers that we would suggest using when you're plugging together your monthly and annual cash flow spreadsheets and pro formas. Now, on an example of vacancy, if you take any one of those percentages, 8, 10, or 13, and you multiply it by the number of days in a year, that gives you the number of days per year that you're allocating towards vacancy. And again, you may buy a C-class property and have a tenant stay for 3 or 4 or 5 years, right? Now that might be just luck, or it might be very good tenant selection. But over a 10 to 15 year period, we do tend to see a little bit more vacancy in lower property classes, partly because the quality of applicants is not as strong as it would be for B and C class. So it might filter through 2 or 3 or 4 different applications until we find a suitable tenant that qualifies based on credit and employment and rental history. But also partly because, as we said before, the job stability sometimes has an impact on keeping tenants longer, and we may see more turnover in lower property classes. So just multiplying that number by the number of days in a year gives you basically the effective income that you will realize on a particular property, because as we know, properties don't stay rented forever. So all of this is because before you buy a property, we want you to be comfortable knowing what you can expect. It's all about setting expectations and having some predictability when you're buying an investment property. It's obviously one of the largest investments that myself or any of you and Daniel will ever make in your life. So it's important to have very realistic expectations. It's not enough to just take the rent on a property and subtract your mortgage payment and HOAs and property management fees. You have to factor in maintenance and vacancy. So these are some of the ways that we analyze an investment property. So I'm going to jump into the next part of our presentation on where it makes sense to invest in real estate. I think we can all agree that not every state and not every city, not every neighborhood, and not every property makes sense as an investment. So then that begs the question, what factors and what criteria point to ideal investment markets? In a little bit, we're going to show you all the 16 locations in the US that Marshall Reddick has our boots on the ground for real estate, property management, and contracting. But to just kind of give you a general overview, some states have very, very, very high property taxes. South Carolina happens to be a state where the property taxes are 4% or more and continuously increasing, much higher than Texas even. So that might not be, very friendly to investors who are trying to get some positive cash flow. Now, there's states that experience very, very dramatic weather patterns, hurricanes, tornadoes, and some areas that the insurance cost is exceedingly high might not be very friendly towards investors either. Now, there are locations like we're sitting in right now in Newport Beach, California, amazing place to own a primary residence, great place to vacation. The average home price is over $1 million, and the rents do not at all pencil out to provide any close positive cash flow whatsoever. Now, there's neighborhoods in just about every major city in the country that have high crime. There's some neighborhoods that have very low crime and very good schools. So we're going to show you the different factors that we use to select the geographic locations that we sell real estate and promote real estate investing. So here are basically the main factors that we have used as a company for well over a decade. And the first and foremost is the job market. So we analyze not based on emotion, not based on entertainment or weather or any emotional factors. We look at statistics, data, and research. And one of the main things we look at is the trend in the job market. So right off the bat, states like Texas, Florida, and Tennessee fall very, very strongly towards the top of some of our locations, because with each one of those states, they do not have any state income tax. So Texas, Florida, Tennessee, there's no state income tax. So because of that, it's very, very business friendly. And we see a lot of major employers expanding or relocating to one of those three states. So we do have more property outside of those locations, but they do fit very well into the criteria we look at. So we look at lower than national average unemployment rate. Our national average right now is right around 5%. And believe it or not, there's some major cities in those states that have 2.5% to 3% unemployment and decreasing as the months go on. So we look at the job market, which kind of has an impact on the population of renters. And if more jobs are being added in a particular market, that increases the population of renters, and it also increases the population of buyers. And more demand for renting obviously puts more pressure on the rental market and helps increase rents over time. And more demand for purchasing puts more pressure on home values and increases the prices of real estate over time. So a lot of that really falls into the job market. Now, low unemployment is nice, but it's not enough, especially if there's only one or two major industries in a particular market. So number 3 is economic diversity. And we're going to show you exactly what that means in a moment. But essentially, we look at major metropolitan markets that have a very balanced variety of industry sectors. So trade, agriculture, government, education, healthcare, technology, all different industries that basically support the long-term outlook of a market. I've seen, and we've all seen before, smaller towns that are supported by one or two major industries, and if anything gets impacted by that particular industry, it has an immediate impact on rents and values. When you have a wide variety of industries, changes between one industry or another will not have nearly as much of an impact on the value of rents and prices. So economic diversity is very, very important, and it's very, very common in a state capital or a major metropolitan market. Housing affordability, we care about that because as investors, we want the most bang for our buck. Right now, the median home price in the United States is about $270,000, maybe about $275,000. We look at areas that have a lower than national average median home price. We want to know if there's locations that have some room for growth, and we don't really target areas that seem to be towards the top of the real estate market. So housing affordability is great because if you can buy 3 properties in one area for the same price as one in another, and double or triple your asset value and double and triple your income, surely that makes a lot more sense for most investors. landlord-friendly laws and policies, very, very important. Every state has a different set of laws for what landlords can and can't do in terms of rent increases, in terms of late paying renters, in terms of notices to vacate, in terms of when and how you can actually enter a property as a landlord. So we look at all of the most landlord-friendly states in the country. And next is education. So very important for us that wherever we sell property, there are major universities and colleges nearby. Examples of that would be in Austin, you have UT. In Indianapolis, you have Purdue. And Phoenix, obviously, U of A, and Arizona State. So again, with major metropolitan markets and state capitals, you're going to see a more influx of students who are eventually going to enter the workforce and buy property or rent property, and that is very key for us as investors too. Lastly, reliable property management. The first six are very easy to find on paper. Having reliable property management is really what makes this whole thing work, and it's just kind of what holds the entire investment together. So Marshall Reddick does provide property management, and towards the end of the property presentation, we're going to get into a little bit more detail on that as well. So this is a very important slide, and we've talked about different locations so far, but I'll spend a couple minutes on this particular slide because this does list all of the markets across the country that Marshall Reddick has a presence in. And what I mean by presence is boots on the ground, licensed realtors, property managers, contractors, handymen, all of the professionals that are necessary to acquire and operate a real estate investment. The reason that about half of them have a red box around them is because those locations are where Marshall Reddick has a brick and mortar office. Outside of those locations, we have third-party realtors and property managers that we designate as regional representatives, and each of them has a broker's license in that respective state. So for some of the markets outside of California and Texas, we have a affiliate broker, and we've been working with each one of them for many, many years. In any one of these given markets, we have anywhere from 200 to 1,000 properties owned by our clients and managed by our team. So no matter where you're looking, if it's in one of these markets, you're investing in a market that hundreds of other clients have purchased in. And just kind of going from the top left all the way to the bottom right, you'll notice that Phoenix, Arizona, Boise, Idaho, Indianapolis, Austin, Texas, a lot of them are state capitals. The ones that aren't, I'm sure you've heard of most of these, if not all of these cities, because they are major metropolitan markets. So our strategy in a nutshell is to provide investment opportunities in suburbs of major metropolitan markets. You've got a few of our markets here on this screen: Memphis, Phoenix, Austin, and Indianapolis. And maybe a little hard to read some of these cities, but I took a Google screenshot of each one of them, and I lined where we actually have most of our properties located. And the illustration I'm trying to get across is that most of these properties that we own and our clients own and we're selling constantly are in the suburbs. And if you look at Memphis, you can see the Mississippi River borders between Tennessee on the right and Arkansas on the left. The downtown of Memphis is right where it says the word Memphis, and the growth is eastward. So you have the higher rated schools, the lower crime rates, and the kind of more consistent neighborhoods as you go further east in areas like Bartlett, Cordova, and Germantown. Let's look at Phoenix. So Phoenix is split between the West Valley and the East Valley. I personally own a property in Tolleson, which is just to the right of Goodyear, about 15 minutes, 20 minutes west of downtown Phoenix. So those areas like Peoria, Glendale, Goodyear on the west, or Mesa, Gilbert, Chandler on the east, again, where you find the long-term family tenants, lower crime rates, better school districts, newer properties, and areas in the path of growth. And then down left to Austin. Austin's growth is north and south, and Round Rock, Pflugerville, Hutto, Georgetown on the north end, and areas like Buda and Kyle on the south end are again where we see the ideal tenants with better credit, higher income, just exact type of tenants that we look for. And then on the right with Indianapolis, you can see that Indianapolis has like a circle. Outside that perimeter are the most desirable suburbs where values are increasing, and again with that higher quality tenant. So the goal really here is to buy within a major metropolitan market so that you're experiencing the growth of that market in terms of the job market, population growth, appreciation growth, and the demand to live there. But you're not in the downtown, you're buying properties just outside of the downtown in the suburbs. Now, the reason that we want to be buying in a major metropolitan market is, just as I had mentioned, we have a larger tenant base. So much easier to find a pool of renters in a city that has 2 million people living there as opposed to a city that has 20,000 people. More diversification of employers leads to a more stable economic outlook. Also provides competition with property management. Obviously, we're not the only game in town, but allows that kind of competitiveness within a particular market rather than just having a one-horse town with 1 or 2 property managers that can really charge whatever they want. That's not the scenario that you want to be in. Higher chance of future population growth comes with the demand to be in a large market and the job growth there. And then larger markets experience greater appreciation due to the job growth, population growth, and et cetera. So I mentioned this a little bit, but why not the downtowns? Well, if you're in the suburbs, you're more likely to attract a family. We advise, if you notice on our website, we advise properties that are mainly detached, single family, 3 to 4 bed, 2 to 3 bath, 2-car garage, detached properties with a front yard, a backyard. Those types of properties are much likelier to attract a family that may have 1 or 2 or 3 kids, may have a small dog or a cat, may not have a pet at all. But those family tenants tend to stay much longer in a property. It's part of the reason that we don't really recommend buying condominiums or townhomes, 1 or 2 bed properties, because you tend to have a lot more turnover and a lot more transient tenants in condominiums and townhomes as you would as opposed to a single family home. So if you've got a single family home in one of these areas, much likelier to attract families that want to be, enrolling their children in the school districts and hopefully stay there for much longer. Better school districts, lower crime rates, newer properties, and experiencing the path of growth are all benefits you get when you're in the suburbs of a major metropolitan market. So that's a little bit about the strategy that we recommend and that we are constantly employing as real estate brokers and property managers. This slide we took off of Google today is a screenshot of the unemployment rate in San Antonio, Texas, showing that the latest census was in November of last year with a 3% unemployment rate. You can see on the right, Austin with a 2.6% rate, Texas as a state, 3.8%, and has been steadily decreasing, really, I think, since 2008, since we saw the minor crash in the real estate market in Texas. 95% of the United States experienced a pretty significant downturn, whereas places like San Antonio, Austin, and Dallas, and Houston saw a very insignificant downturn, entirely due to the economy of Texas. So one of the benefits of Texas really is the business-friendly climate. Now, this is an article that we took off of Forbes, and this is kind of old news now, but if you look at the last paragraph at the bottom, Those of you that live in Los Angeles or are familiar with the LA market may know that a little over a year ago, Toyota relocated their headquarters from Torrance to Plano, Texas, and that brought 4,000 jobs to the Dallas-Plano market. We've seen so many major companies like Apple expanding in Austin in their locations in Round Rock, all throughout Austin, really. Other companies like Charles Schwab that moved hundreds of jobs outside of California to Austin and El Paso. It's not on here, but Liberty Mutual, one of the largest insurance companies in the country, set up a location in Dallas and brought 5,000 jobs. This is about a year or two ago. FedEx opened a new location in Dallas and brought 1,500 jobs with them. So, this is just the ongoing continuous trend because of the business-friendly climate. And, if you've got low regulations, high workforce, low taxes, low cost of doing business, it's just going to continue on and on and on in this trend. Now, I'm not saying that we all just pick up and move to Texas, but being an investor and having the ability or the freedom to buy wherever you want or wherever you can, this is definitely one of the most important factors to look at as we're seeing that kind of continuous growth in population, jobs, rents, and values. This screen here was taken from the U.S. Bureau of Labor Statistics that Google actually pulls all the data from. It's a government website that tracks the unemployment rate. You can type in any city in the country and it'll give you this graph that's called the industry mix. So we can see with San Antonio, I know it's a little hard to read the letters on the right, but those are all the major industries in the San Antonio, Texas market. And you can see that the largest industry, being the office and administrative support, is only 18%. Now, you can look at other cities in the country that have 30, 40, 50, 60% of employment in one industry. And that is basically the root of what would cause a risky market. What would cause a market to be risky to invest in would having the majority of jobs in one market. But when you get a nice even mix like this, it's much less likely to experience volatility in values and rents. CNN Money is a great media source that we follow, and here's an article on the Memphis, Tennessee market. So Memphis, Tennessee is constantly being named as one of the most affordable, undervalued markets in the country. And what we notice is that it's a little bit unique in Memphis, where a higher percentage of residents rent than own. You can find areas where, anywhere from maybe 30 to 50% of the market owns real estate, where in Memphis, it's much closer to 30%. So because of a lower population of residents that own property, it puts a lot more demand on the rental market and not much demand on the real estate market. So what that does is it keeps the prices of the values steady over time. So we don't see major jumps year over year in values, but we do see continuous ongoing increases in rents. And when you have a steady valued market where rents are going up faster than values are, that creates more of an opportunity for positive cash flow. Now, the opposite issue exists in the coastal cities, where we see values going up much faster than rents do. That hurts cash flow, and that's what causes an environment of negative cash flow, where the opposite exists in Memphis. So that's why in Memphis, it's very common to see very, very high cash flow, because values sort of stay steady where rents continue to go up over time. Forbes also published an article on one of our top markets, the Cape Coral, Fort Myers market in Florida. Now, some people hear Florida and they think right away, oh my gosh, the weather, hurricanes, no way. Now, that may be true on the east side of Florida, where you see the weather patterns coming from the Caribbean. And anytime that, there's hurricanes, it kind of touches in like Key West or Miami or Fort Lauderdale, where we're in a market on the west side of the peninsula that rarely, very, very rarely, and much less common to see devastation from a hurricane. We've been selling property in Cape Coral, Fort Myers for, probably about 13 years now. And the largest hurricane that we've seen in our country's existence, which was Irma last September, had very, very little property damage to the 250 properties that our clients own in that market. Now, what's great about the Cape Coral market is you see much newer properties, and because of the demand for vacation and also for year-round employment, values are continuing to increase. Cape Coral was also named last year as America's #1 fastest growing city in the country. They've got major employers like Hertz Rental Corporation. Boston Red Sox have a major training facility. Walmart has one of their super centers, and just kind of continuous growth in retail, distribution, manufacturing, and a lot of other industries. But it's also a very affordable market where the average home price is about $200,000, which is still lower than the national average. So it's more than just a vacation destination. Happens to be an amazing real estate market. And we even have a property that Daniel's going to be showing you as an example in just a little bit. So I'm going to do one more little interactive poll here, and then we'll jump to the next part of our presentation. But I would love to get a little bit of an idea for the interest trend in the different locations that we showed. And you may not know too much yet on where you want to invest, and I promise we're not going to hold you to it. But I would love to find out of the states that Marshall Reddick has real estate investments in. Love to hear, if you had to pick one of them. And we are in other states like Arizona, Nevada, and Idaho. I just picked California, Texas, Tennessee, and Florida. I'd love to hear each of your thoughts. So if you wouldn't mind clicking one, we'll share the results in about 10 seconds. Just really fun and interesting always to see a little bit of feedback from those of you on the website on, where you can see yourself buying investment property if you had to choose one of those markets. Try and give you guys a few more seconds there. We got a few stragglers that haven't made up their mind yet, but again, this is not binding. So, all right. Okay, I'm gonna go ahead and close the poll here. So we must have a lot of Californians on the webinar tonight. It looks like about 38% of you are interested in California, and it's where our headquarters is located. We have a lot of investment opportunities throughout Southern and North. We've got about 31 of you looking at potentially Texas, 25 in Tennessee, 0% in Florida. Ah, man, I must have scared you off with the hurricane thing. We'll get some of you to see the opportunities in Florida, and then 6% said other. So thank you guys for interacting on our webinar. And Daniel is going to share some of the ways to acquire investment property.
All right, thank you so much, Scott. I hope you guys are still there with me. Really interesting results on the polls. Like I said earlier, there's a very diverse group of investors on the webinar tonight. So want to talk a little bit about methods of purchase, because there are multiple avenues that you as an investor can take. First and foremost, conventional financing. Conventional financing, you have a lender guaranteeing you, the borrower, based on your income, your employment history, your credit score, etc. This is an avenue where you're going to get the best interest rate, the lowest down payment, and we're still seeing historically low interest rates. So right now is a great time to borrow money. And if you can qualify for conventional financing and leverage your investment in that sense, then we certainly recommend you do so. And we have a phenomenal conventional lender. His name is Reed Hazard at AmeriFirst. We'll show you his slide a little later, who's licensed in all of our markets and can help you in that sense. Some of you have an incredible amount of equity. Those Californians who bought several years ago, I'm talking about you guys, and you can pull out that equity and use that to invest out of state, see essentially higher returns on that money. Private financing, we talked a little bit about this for those of you who either can't utilize conventional financing because you can't qualify. I got to say, the least amount of investors utilize private financing for that reason. Private financing, we actually see used a lot more with those of you who are investing with your self-directed retirement accounts. Now, that could be a self-directed IRA or a solo 401k. So if you didn't know, if you have a 401k with a previous employer, you can essentially use those funds to invest in real estate, and you can even leverage through private financing. Cash is certainly always an option, and you're going to see an incredible cash flow from an all-cash purchase. And then 1031 exchange. Now, some of you might be asking what a 1031 exchange is. It's actually a way that you can take equity from an investment property, move it over to other investment properties, and not pay your capital gains tax, because Uncle Sam, and for those of you in California, Uncle Jerry, want their cut of your gain. And we've helped countless clients facilitate flawless 1031 exchanges. There are many rules that you have to follow, timelines. You need an intermediary, and we have a great one with whom we can get you connected. So many of you in California, like I was just mentioning, invested in California, saw rapid levels of appreciation, have a large sizable gain, and can now actually move that equity without paying your capital gains tax. It's deferred capital gains. Eventually, the properties that you exchange into, should you sell those, you are subject to a capital gain. But for the time being, you can move the equity without paying a capital gains tax. So talked a little bit about this. This is our preferred lender, Reed Hazard at AmeriFirst Financial. Reed, we've been working with him for around 13 years now. He's licensed in every single one of our markets, incredibly knowledgeable. He can help you here in California for your primary residences or investment properties here, and in every state and market that we do business in. He's incredibly knowledgeable, always available nights, weekends, and many of you on the line have already spoken with Reed before, but this is a very helpful little flyer for those of you who are going to be submitting your loan application soon. There are certain do's and don'ts, so to speak, to help you qualify for a conventional loan and qualify for the highest amount as well. And we can certainly send this over to you after the webinar. I'm going to be giving each and every one of you a call, and if you'd like this sent over, I'm happy to do so. So really quickly on how to choose the right lender, I'd say most important aspect is their availability, their customer service, and Reed is a direct lender. Now, what does that mean? It means processing and underwriting are in-house. The same people that are working on your loan are funding your loan. They're all in the same branch office in San Clemente. It's efficiency. And I got to tell you guys, a lot of deals fall through in real estate because people are working with the wrong lender. And that happens very, very infrequently working with Reed and his team because they are, like I said, direct lender, incredibly knowledgeable, professional. Their customer service is second to none. And here's their contact information, although I'm happy to get any one of you connected with them directly as well. Here's our terms for our long-term mortgages that we offer directly through our private financing program here at Marshall Reddick Real Estate. You'll see that we have various loan options available. These are 60% max loan to value. So that means it's a 40% down payment. You can see the interest rates vary between 6.5% to 8.5%. And for those of you who are, for example, investing with your retirement funds and would like to leverage through our private financing program, what we can do, or what I can do, is get you connected with our VP of private lending, and he can go through the ins and outs. And the key difference here, guys, is that through a private loan, you are not qualifying for the loan. Your credit is not being pulled. It all has to do with the property itself, that it is financially sound, and that the property can qualify for our loan program. So I asked earlier, what's most important in terms of an investment return for all of you? And the two biggest metrics that we as investors use are appreciation and cash flow. So appreciation, how much is your property gaining in value over time? And cash flow, how much passive income is going into your pocket every month? We're going to talk about how those are calculated in just a moment here. So first and foremost, I want to go into this snapshot of the San Antonio metropolitan area. The appreciation over the last 25 years, and this is data pulled directly from the National Association of Realtors. You can see the median home price in the San Antonio metro at just under $207,000, as is the most recent data that we're pulling from our National Association of Realtors in 2016. Now, one thing to highlight here, guys, San Antonio is a phenomenal market if you're looking for slow and steady appreciating asset, low volatility. If you take a look there at what happened during the greatest recession of our lifetime in 2008, almost no depreciation. Pretty much just kept chugging along. And like Scott was saying earlier, that's really a testament to the economic diversity in larger Texas metropolitan areas. This is a property I am so excited about sharing with you guys tonight, because it's so rare that we have larger multifamily properties such as this one available in San Antonio, because when they come available, they are snatched up very quickly. This property is a fourplex. It's a brand new construction fourplex in San Antonio. It's already been built. Each unit is 3 bedrooms, 2.5 baths. I can send you the link for any of you who would like to see later, so you can see the inside. It's really immaculate. And I spoke with our regional rep this morning, and we talked a little bit about the availability. There were 4 that came available. There's 2 left currently. But this is a property where each unit rents for about $1,200. And even so, if you look at that bottom number, like I said, a great market for appreciation. You're seeing a return on your investment over 15 years of over 21%. Now, I'd be willing to bet a lot of you in your stock portfolios hadn't seen a return as high as 21%. And then you might ask me, well, how are you calculating that 21%? That's a great question. Annual return on investment is calculated by taking the total profit from your sale. So profit includes your appreciation, your accumulated cash flow, your principal pay down, which is the principal you pay down on your mortgage over owning the property, and subtracting your selling expenses over that total cash invested over the number of years held. So all of that is broken down on our website. You can see this is a snapshot. This is the 21.78% that we had shown you on the property pro forma. This is a snapshot directly from the website showing every metric of this property and the dollar value relative to every means you're experiencing a return in owning a real estate investment. So you can see when I say San Antonio is a great market for appreciation, you have a total projected profit after 15 years for this brand new construction fourplex of over $500,000. $420,000 of that is coming from this property appreciating. And that appreciation trend is simply factored over taking the data of the last 25 years and applying it to the average appreciation for the next 15 that you're holding the property. So in this case, we have our $502,000 that we're saying we're profiting after 15 years, divided by our initial investment of $153,800 over the number of years we've held the property, 15. That's what our financial calculators default to. That being said, that's adjustable. So if you want to go on there and you're planning on holding property longer or shorter, at least want to see how the returns will change, you can do so. And one of my favorite things to do with investors, guys, is taking you through our financial calculators line by line and explaining how we calculate every single calculation and every factor in there, because once you understand how to utilize that tool, you're going to be able to evaluate any real estate investment. But this is essentially how you will calculate your annual return on investment and how our financial calculators do calculate your annual ROI. And in this case, over a 15-year hold, you're seeing over 21%. Here's a snapshot of our financial calculator. You're going to see one of these under every property on our website. Our regional reps are uploading property and inputting the necessary data every day for our financial calculators to then pull and calculate your returns that you can expect investing in any given property on our website. And it breaks it down to what you can expect to pay to invest in a property, what you can expect to see as far as returns go, or to pay for your fixed expenses or your variable expenses. They're very detailed, they're adjustable, and you'll notice a little FX next to any sort of calculation on our website. If you click that little FX, it'll show you exactly how a return is calculated. So Scott talked a little bit earlier about certain trends we see in coastal cities. And we also talked a little bit about your risk tolerance. Now, you can see that a coastal city, Fort Myers, Florida, for example, behaves a little more like a Los Angeles or an Orange County metro. A little larger swings in terms of the market. When the market's great, we appreciate very high. When it's not so good, we see more depreciation. That being said, over the long term, your average appreciation is still positive. Over the last 25 years, your average appreciation in the Fort Myers metro is still just under 4%. So regardless of where we are at the market, currently, over 15 years, even if we see a full real estate cycle, historically speaking, we see that your property is still going to be valued more in 15 years than it is for when you purchase the property. And if you take a look at that 25-year trend, we haven't recovered to, at this point in 2016, when this data was pulled, we have yet to recover to that point that we were in 2008. And it's still steadily appreciating in this Southwest Florida market. I'm really excited about this property as well. And I'm glad I chose this property to showcase tonight, because earlier when I had asked what types of returns you as a group were most interested in, the majority of you said both cash flow and appreciation. Southwest Florida is my favorite market if you are an investor who wants the best of both worlds. Not only is this a market with very strong job growth, many qualified employees moving to the area because of expansions in healthcare, expansions as far as infrastructure goes. So we're really seeing an influx in the population of demand for rental housing, which is causing not only is it causing the average or the median home price to increase steadily, but it's also causing a shortage of available rental housing, which is driving rents up. So you really see the best of both worlds in a market like Southwest Florida. You can see towards the bottom of your screen there projected annual ROI of almost 20% over 15 years. But you can also see a monthly income of almost $900. That means that every month after your fixed expenses are paid, there's over $881 going into your bank account every month. Now, that's not to say that you're not going to have maintenance and vacancy, and you can see those under your monthly income calculation. But that's still saying after fixed and variable expenses are paid, your cash flow monthly is over $400. So not only, like I said, is this a property that's appreciating very well, but also providing you passive income every month. This property I chose specifically as well because if you go on our website and take a look at the interior, this property has been completely renovated and very beautifully. This is on average rents for a duplex in Lehigh Acres are about $1,000 to $1,100 per month. I saw one side of this duplex being advertised for $1,200 a month, which is almost unheard of. But this duplex is still available, incredibly well renovated, and really a phenomenal investment for those of you who are looking for both, which was the majority of you. So a quick breakdown of how that cash-on-cash return is calculated. It's simply your annual net cash flow. Now that's after both variable and fixed expenses, divided by your total cash investment. So your down payment, your closing costs, and your initial repair costs. And this is showing that even after your variable expenses are paid for this property, your cash-on-cash return is still over 7%, and your annual ROI almost 20%.
All right, awesome work, Daniel. You know, it looks like everybody's still on, and we really appreciate you guys. I know we've gone over an hour. So hard to do all this in less than an hour. I mean, we've tried so many times, but anyway, I'll shut up and continue. So hopefully you guys stay on. I think we'll definitely end in the next 15 minutes, but I wanted to share with you the real value that Marshall Reddick provides is the team approach. Real estate investing is definitely a team sport. It doesn't really matter how smart you are, how educated, experienced, even how much money you have. I mean, those of course, those factors carry some relevance, certainly, but what it really comes down to is the people you're working with. Who you work with is more important than where and what you're buying. And all of these individuals are some of the main key players in not just acquiring a property, but making sure that year after year after year, you're ensuring continuous performance of your rental property. Daniel, as he mentioned, is number 1 and number 3 on here. So Daniel is a licensed California realtor. He also acts as an advisor for investors looking to purchase outside of the California market. So he would be able to help you put together a game plan looking at all the markets we're in, evaluating your criteria, evaluating your time frame, evaluating what options you have, and then pointing you in the direction of not just your first property, but helping you get to your second, third, fourth, and continuing on until you have a portfolio of properties that provides the end goal that you're looking for. Marshall Reddick has the professionals in each one of these categories. Number two, we talked about Reed Hazard and the AmeriFirst Financial team we've been working with for 13 years. We have a large team of realtors in California, as well as every other state that we shared. We really do prefer to work with buyer's agents because buyer's agents are not going to be biased on the particular property. So we don't really work directly with the listing agent. It's really more of the buyer's agent that can evaluate the properties in the market and help our clients take advantage of any property really that makes sense for them without a bias to a particular property. So for us, we really do like working with realtors that have that experience and knowledge on their local market. Next is the building inspector. We always advise our clients to order a building inspection after they sign a purchase agreement during the escrow process to help you give a very good understanding of every particular detail on the property you're purchasing. So we have preferred building inspectors. We have preferred insurance agents that can help you choose the correct policy with the right amount of coverage for your property. And then, of course, we provide property management. So each one of these professionals are very, very important. And, we don't just tell you, hey, here's a great property and sell it to you and then say, hey, go figure out the rest. I mean, we really do plug in the pieces of every single item that you would need in acquiring a property and then ongoing year after year after year, all the way through selling a property. About half of our sales are people selling property and the other half are people buying property. We have investors who bought property with us in the late 90s, early 2000s, 2009, 10, 11, 12, that have seen a lot of appreciation in their properties and are now looking to do what Daniel mentioned, performing a 1031 exchange to sell, take that equity and really spread it out into maybe more properties, or selling multiple properties and consolidating it into one large multi-unit that provides a lot of cash flow. So from everything in between, Marshall Reddick provides the people that help make this whole thing work. So one of the last things that I'm going to talk about is property management. Now, I consider property management the make or break factor in real estate investing, kind of like the X factor. You can find a market that has strong jobs, economic diversity, high cash flow, low property taxes, low insurance costs, just all these different factors that make for great investments. But if you don't have the right team leasing your property and advertising it for rent and qualifying applicants, doing the background checks and screening, managing the tenant, setting the expectations, following up and enforcing the rent payment and responding to maintenance issues, and just really taking care of those tenants. If you don't have that, it doesn't matter how good the market is, it doesn't matter how low the unemployment rate is, it doesn't matter how strong the job growth is. None of those things matter if you don't have good property management. So that's why I call it the make or break factor. So right now we Marshall Reddick in-house manages property in Orange County, California, Los Angeles, Northern California, throughout the Bay Area, San Antonio, Texas, and Austin, Texas. Those are where Marshall Reddick manages in-house, and meaning that Marshall Reddick employees are the ones leasing and managing properties. And then the other markets, we prefer to work with the professionals in those locations that we've worked with for many years. But no matter where you're buying property, you're going to see a very consistent trend in the service and quality of property management. So I want to talk through this for 1 second. Let you know that we really do put a lot of value in software. We know that part of the secret of being a good property manager is having excellent software to keep everything organized and allowing tenants to pay online and submit maintenance requests online and so on and so forth. So we're always looking at enhancing and improving our software to really help us be a very efficient management company. Then next to the right, is there a maintenance conflict of interest with a property manager that you're considering to use? What I mean by that is, you may be talking to different property managers and there is very little consistency with property management. Not all property managers are created equal. You have some companies that only do property management and don't sell real estate. You may see higher expenses because they need a profit purely on property management. Whereas a company like us that sells real estate and also does property management, we're not relying on property management to be a major profit center for us. With that, we contract out the maintenance and repairs. So we're not actually profiting from maintenance and repairs. Now, one of the mottos we always use is a good property manager only makes money when you're making money and doesn't make money when you're losing money. And the conflict of interest is very, very prevalent in our industry, where a high percentage of property managers either do maintenance and repairs in-house, maybe they're a general contractor, or they may even refer the maintenance and repairs to a third-party contractor and add on, a surcharge or a markup on top of the work performed by the contractor. That goes completely against the functioning relationship between a good property manager and a landlord. So for us, any of the maintenance and repairs, the money goes directly to third-party contractors. And for us, all we care about is using reliable, licensed contractors who are cost-effective, but who are more than anything reliable and have a good track record with us. So very important you're not working with a property manager who is looking at maintenance and repairs as a profit center, because that is not going to be in your best interest. We're not the cheapest property manager in existence. We're not the most expensive. We simply provide the best value. So in choosing a property manager, you want to look at not just the cost of the management fee, but also the leasing fee. Are there any additional setup or admin fees? Are there any trip charges? Some property managers charge fees every time they visit a property, which is crazy. We do not charge any fees, any management fees during vacancy. Although that might be common, there are some property managers who do charge management fees during a vacancy. Again, they're making money when you're losing money. So I recommend looking at a company like us that has excellent reviews online, hundreds of happy clients, always available to provide references, but have a very fair fee structure. Responsiveness. If you're communicating with a property manager that you haven't actually hired yet and they're taking a long time to get back to you, they're probably doing the same thing with their potential renters looking at renting a property, and maybe even their current renters who live in the properties they manage. Responsiveness is the #1 most important personality trait or character trait with property management. So we definitely pride ourselves on being very responsive and being available on nights and weekends as well, because property management and real estate is an around-the-clock type of investment. Looking at places like Yelp and Zillow are very important to see what owners and tenants are saying about a property manager. And then also cancellation policy. Is a property manager going to charge you excessively high fees to cancel? To me, that kind of raises a little bit of a red flag. I would look at a company like ours that's very flexible and open-ended and really only likes to work with landlords who are having a good experience. I'm going to recommend that you guys check out the management section of our website, marshallreddick.com/management. On this page, you'll find all the services that we provide to tenants, landlords, and property. You'll see the pricing sheet for all 16 markets that we're in. So if you click on any one of those cities, it'll expand and show you the fee sheet for the fees in each market for property management. On this section of our website, we have our available properties for rent. We have our owner and tenant login. So very good place to find out more about our property management. So the finale of the presentation, we've talked about really just benefits of real estate, but I'd like to touch on the risks. So I always look at an investment and I want to know, what are the worst case scenarios? What are the major risks? What's the worst thing that could happen? I like to, assess the risk before taking action for an investment. So some of the major risks are vacancies, maintenance and repairs, property values going down, natural disasters. You can also look at like liability, from tenants or, not having enough asset protection, causing liability for an owner. Those are really essentially the main risks when owning investment property. One of the things that I love most about investment property is that with the right amount of knowledge, education, and the right team, you can significantly decrease the risks as much as possible. So I have here very clear articulated ways to decrease each one of these risks. So for vacancy, like we talked about, higher property classes experience lower vacancy. Buying within the boundaries of a major metropolitan market, experiencing that rental demand are going to help lower vacancy. And of course, hiring a professional property manager that's going to be very assertive and very hands-on will certainly help you decrease vacancy. With maintenance, right off the bat, getting a home inspection while you're in escrow will tell you literally everything about that property. It's kind of like a Carfax report for buying a car. The condition of the roof, the condition of the heating, furnace, and air conditioning, testing for mold, termites, looking at the attic, electrical wiring. All these different things are going to be evaluated from a home inspection, and it'll give you a really good idea for the potential deferred maintenance in the future on that property. And then after you buy the property, from there you may be able to foresee some of these repairs coming without being surprised. Higher property classes experience lower maintenance rates, again, because we talked about the quality of tenant. Newer properties, a new property or a turnkey property will also have less maintenance. A turnkey means that the seller who sold the property did all the work to remodel the home or make it a move-in ready property. So if you've got new appliances and newer roof and newer heating and newer furnace, it's much less likely you're going to experience ongoing maintenance of that property. Property values. If you're able to put at least 20 to 30% down and have a positive cash flow, as long as you're buying in a metropolitan market like the ones that we've described that have a lot of rental demand, you should be able to hold on to that property long enough for the values to come back to provide you with enough equity to eventually sell it. So positive cash flow is really the glue that holds the property together long enough for you to experience long-term appreciation. Lastly, with the right amount of liability coverage and also the being insured for replacement cost, having the right insurance coverage, it will allow you to not lose significant amount of money if there are natural disasters or claims for liability. We usually recommend at least $300,000 of liability coverage. You definitely want to make sure that you have the right amount of dwelling coverage and that there aren't major exclusions for investors and things that could come up being an investor. With that, we can connect you to our insurance agent who can give you a lot more information about the proper insurance coverage for the rental property you're looking at. All right, so if you do everything we say, if you're following the Marshall Reddick system, then we have a very, very strong sense that this is what you'll look like after buying a property. That was me, Scott, 8 years ago after I purchased one of the properties that I own in Phoenix, Arizona. It was the fourth property I made an offer on. I had to be very, very aggressive. But give you an idea, that's one of the properties that I own in Tolleson. But that is really what we try to create. I mean, we want to be working with investors whose expectations were exceeded and who are ecstatic about working with us so that they eventually continue to build their portfolio with Marshall Reddick. We want to be and are, for many people, the lifelong partner for all things residential real estate. So in conclusion, Daniel is going to reach out to you guys either through phone or email in a very kind of informal, casual setting to schedule a phone call at a time that works for you guys and ask you a lot of very pointed questions and allow you to ask as many questions as you want, all for free. We don't charge for education. We don't charge for mentoring because we are the source for purchasing property, managing property, and borrowing borrowing for mortgages. You know, we make our money as transactional, you know, not upfront. So really that means that, you know, we're with you guys every step of the way. Could be for months, could even be for years until you ever actually do buy a property. And we just want to guide you in the right direction so that when you eventually do go to purchase real estate or sell real estate, hopefully that you work with us. I highly recommend that you guys take advantage of this consultation phone call to help you define your why, how, when, what, where, and who. Even if you think you know it all, I guarantee you're probably going to learn some really, really important pieces of information on that phone call. And it's a way to really personalize all the information that you learned with us tonight. So you can go on marshallreddick.com/consultation. There's a few questions that will help Daniel figure out how to prepare for the consultation. But we really, really look forward to hopefully speaking with each one of you. You may have no idea if and when you want to do this or how to do it or where to do it or even why to do it. And that's what we're here for. You know, like Daniel said, something brought you here on this webinar, and we'd love to hear your questions, your concerns. You know, we've really heard it all. We've worked with tens of thousands of people from beginning to advanced. And, you know, whether you own 10 properties and you're looking to start selling them, or you just heard of real estate investing yesterday and you have no idea what to do, we worked with everyone from A to Z. And we really like to provide a one-on-one, very personal experience and game plan for each client, because everybody really is different. So we both appreciate you joining us on the presentation. This presentation is recorded, so we'll make sure that each of you do receive a copy of the recording. If you haven't already, click on the handouts section of your subpanel, download the Reddick Rating ebook. You have a couple other handouts on here as well.
Correct. Yeah. For the two major markets that we talked about tonight, guys, San Antonio and Southwest Florida, you'll see that market data packet that we talked about a little bit throughout the presentation. Very comprehensive data packets that will go into the ins and outs of the metropolitan area. And we have those actually available for each and every single one of the markets that we're in. You can see here, if you go to marshallreddick.com/market data, you'll be able to access the market data packets for the metropolitan area that you're most interested in learning more about. The Learn tab of our website is an encyclopedia. It is a wealth of information. Every single webinar that we've done is recorded, available to rewatch. You'll find all our market data packets. You'll find information on financing, on the different programs that we offer here at Marshall Reddick Real Estate. Everything that you could want to know about investment property, residential real estate, available right there on the website, all for free, so that you can all do your due diligence and your research and be ready to move forward with a real estate investment that best matches your goals. I'd highly recommend checking out our reviews online, guys. See what other people are saying about us. Don't just take our word for it. Zillow and Yelp here, two of the many sources that you could take a look at. But like I said, very informative, and you'll see the experience that other investors have had working with us here at Marshall Reddick. And amongst those other sources, we're on Facebook and Instagram and LinkedIn, YouTube. We'd love to connect with you. Check out what we're saying, what we're doing, And in addition to that, I appreciate each and every one of you for being on the webinar with us tonight. I hope you learned something new. I'm really looking forward to speaking with you all, getting to know more about your individual goals, and ultimately helping you out identify the criteria that is most important to you, and helping you invest in real estate, build wealth over the short and long term timeline.
Thanks, everybody. I know some of you guys typed in questions. Daniel will make sure to address those on the phone call. We'd love to get to know you a little bit better, and kind of expand on some of the questions that were typed in tonight. We apologize we didn't have enough time to go over them on the webinar. We do look forward to talking to you in more detail, and really creating a long-term relationship that's mutually beneficial. So thanks again for joining us, and happy investing. We look forward to talking to you soon.